Welcome back to our channel, team. It's your Dust, the Wealth Architect here. Today, we're diving deep, really deep, into a topic that touches every single one of us: the financial habits of rich and poor Indians. This isn't about judgment, my friends. It's about understanding. It's about peeling back the layers to uncover the secrets, the mindsets, and the daily choices that shape financial destinies. We're going to explore the subtle yet powerful currents that guide spending and investment, and how these currents often lead to vastly different shores. My goal today is to equip you with knowledge, to spark that inner curiosity, and to help you see the path to financial well-being more clearly. India is a land of incredible contrasts, a vibrant tapestry woven with threads of immense wealth and challenging poverty. And often the difference lies not just in opportunity, but in financial wisdom, a wisdom that can be learned, adopted, and cultivated. We'll be looking at specific patterns, the kind of financial DNA that differentiates those who build lasting wealth from those who find themselves in a constant struggle. Think of this as a journey into the financial psychology of our nation, a quest to understand the why behind the what. It's about empowering you to make conscious decisions, to break cycles if needed, and to build a future where your money works for you, not the other way around. So, grab your chai or coffee, find a comfortable spot, and open your minds. We're about to embark on an enlightening exploration that could fundamentally change the way you look at money. Let's uncover the secrets behind their spending choices, dissect the strategies, and ultimately, learn how to navigate the complex world of personal finance with greater confidence and success. This isn't just about numbers, it's about life, freedom, and the power of informed choices. Are you ready to transform your financial future? Let's begin. When we talk about how wealthy Indians build and sustain their fortunes, one asset class consistently stands out: real estate. It's more than just brick and mortar. For many, it's the very foundation of their financial empire, a tangible symbol of stability and growth. I've seen firsthand, and through countless stories of successful individuals, that strategic investment in property is often a cornerstone of their wealth-building journey. They don't just buy houses to live in, they acquire properties as assets, understanding their inherent value and potential. This approach is deeply ingrained in the Indian psyche, where land has always been equated with security and prosperity, a legacy passed down through generations. The magic of real estate, especially in a developing and densely populated country like India, lies in its dual power: appreciation and income generation. Think about it. A well-chosen property in a growing urban area or a strategically located commercial space doesn't just sit there. Over time, as demand increases and infrastructure develops, its value tends to climb, often outpacing inflation. This appreciation is like a silent engine, steadily growing your net worth. Furthermore, these properties aren't just idle assets. They can be powerful sources of rental income, providing a consistent cash flow that can be reinvested or used to fund other ventures. It's this combination that makes real estate such a compelling proposition for the savvy investor. But it's not just about the numbers, team. Investing in real estate is also about a long-term vision. It's about understanding market cycles, identifying potential growth corridors, and having the patience to see those investments mature. It's a commitment, a strategic play that often requires significant capital and due diligence. But the rewards can be immense, creating not just financial wealth, but also a sense of rootedness and a legacy for the future. This isn't just about buying a plot of land, it's about cultivating a piece of the future, an asset that provides both financial and emotional security, a true cornerstone of lasting prosperity. Now, let's shift our gaze to a different pattern, one that often characterizes the financial habits of those who struggle to build wealth. This is the allure of depreciating assets. What are these, you ask? Simply put, these are items that lose their value almost as soon as you acquire them. Think about that brand new car driving off the showroom floor, the latest smartphone model that will be outdated in a year, or expensive gadgets that offer fleeting satisfaction but little to no long-term financial return. It's a cycle of spending that can feel good in the moment, but often leads to a financial dead end, a constant drain on resources. The reasons behind this spending pattern are complex and deeply human. Often it's driven by societal pressures, the desire for instant gratification, or the perceived status that comes with owning the newest and shiniest things. We live in a world bombarded by marketing messages that tell us we need these items to be happy, successful, or accepted. This creates a powerful pull, especially when financial literacy is low, and the long-term consequences aren't fully understood. It's easy to fall into the trap of equating spending with lifestyle, without realizing that true financial freedom comes from assets that grow, not those that diminish. The financial impact of consistently prioritizing depreciating assets over appreciating ones is significant. Every rupee spent on an item that rapidly loses value is a rupee that isn't being invested, isn't growing, isn't working to secure your future. It's the opportunity cost that really stings in the long run. While enjoying life and having nice things isn't inherently bad, the imbalance, where spending on liabilities far outweighs investment in assets, can create a cycle of financial vulnerability. It keeps individuals on a treadmill, working hard but never quite getting ahead, because their money isn't being put to work effectively to build a secure financial foundation. Chapter 3. Beyond bricks, diversifying with stocks and bonds. For the truly affluent and financially savvy in India, wealth creation doesn't stop at real estate. They understand the critical importance of diversification, and that's where financial instruments like stocks and bonds come into play. These aren't just complex terms for Wall Street wizards, they are accessible tools that, when understood and used wisely, can significantly accelerate long-term financial growth. Rich Indians often see stocks as a way to own a piece of growing businesses, participating in their success and profitability. It's about investing in the engine of the economy itself, betting on innovation, growth, and the future prosperity of various sectors. Bonds, on the other hand, are often viewed as the stabilizing force in a diversified portfolio. They represent debt, essentially lending money to governments or corporations in return for periodic interest payments and the return of principal at maturity. While typically offering lower returns than stocks, bonds provide a cushion against market volatility, preserving capital and generating a more predictable income stream. The key here, as practiced by wealthy investors, is not to put all their eggs in one basket. They meticulously craft portfolios that balance the growth potential of equities with the relative safety of fixed income securities, tailoring the mix to their risk appetite and financial goals. This strategic allocation to stocks and bonds is driven by a long-term perspective, a deep understanding of the power of compounding. It's not about timing the market or chasing quick profits. It's about patient, disciplined investing that allows wealth to grow exponentially over decades. This approach creates a resilient financial structure, one that can weather economic storms and continue to generate returns. By embracing these financial markets, rich Indians are not just preserving their wealth, they are actively multiplying it, building a sophisticated financial engine that works tirelessly to secure their financial independence and create intergenerational prosperity. This requires knowledge, research, and often guidance from trusted financial advisors. Chapter 4. The quicksand of credit, the perils of high-interest debt. On the other side of the financial spectrum, a common pitfall that ensnares many and hinders their journey to financial stability is high-interest debt. I'm talking about credit card debt with exorbitant annual percentage rates, personal loans taken for consumption rather than investment, or predatory payday loans that promise quick cash but come with crippling interest. The allure is understandable. Easy access to funds when you feel you need them the most. However, this convenience often masks a dangerous trap, a financial quicksand that can pull individuals and families deeper into a cycle of repayment struggles. The mechanics of high-interest debt are designed to work against the borrower. The interest compounds rapidly, meaning you end up paying interest on the interest, and the principal amount can seem to barely shrink despite regular payments. This creates a treadmill effect where individuals work hard just to service their debt, with little left over for savings or investments. The stress and anxiety that accompany such debt can be overwhelming, impacting not just financial health, but also mental and emotional well-being. It's a heavy burden that limits choices, stifles dreams, and can create a feeling of being perpetually trapped by financial obligations. It's crucial to distinguish this from strategic debt, which wealthy individuals sometimes use. For instance, a mortgage on an appreciating property or a business loan to fuel growth, often secured at more favorable terms. The difference lies in the purpose and the cost of the debt. Poor Indians, often due to lack of financial literacy, limited access to better credit options, or immediate pressing needs, fall prey to these high-cost debts that erode their financial capacity. Understanding the true cost of borrowing and prioritizing the avoidance of high-interest consumer debt is a fundamental step towards financial liberation. It's about breaking free from these chains to build a future based on assets, not liabilities. Chapter 5. The Ultimate Investment, Education and Self-Improvement. Beyond tangible assets and financial instruments, there's another crucial investment that consistently differentiates the approach of wealthy Indians: the profound belief in and commitment to education and continuous self-improvement. This isn't just about formal degrees from prestigious institutions, though that certainly plays a role. It's about a lifelong dedication to learning, acquiring new skills, staying updated with industry trends, and enhancing one's own human capital. They understand that knowledge is power, the power to innovate, to adapt, to lead, and ultimately, to earn more and make smarter decisions. This investment in oneself manifests in various ways: pursuing higher education, attending workshops and seminars, reading voraciously, seeking mentorship, learning new languages or technical skills. Each of these actions expands their capabilities and opens doors to better opportunities. In a rapidly changing world, the ability to learn and evolve is perhaps the most valuable asset one can possess. Rich Indians often instill this value in their children from a young age, understanding that a well-educated and skilled individual is far better equipped to navigate challenges and seize opportunities, leading not just to higher income potential, but also to greater resilience and adaptability. Ultimately, investing in education and self-improvement is about cultivating a growth mindset. It's the understanding that your abilities and intelligence can be developed through dedication and hard work. This mindset doesn't just lead to better career prospects, it permeates all aspects of life, including financial management. A more informed, skilled, and adaptable individual is naturally better at identifying investment opportunities, understanding complex financial products, and making sound judgments with their money. It's an investment that compounds over a lifetime, yielding returns that go far beyond mere monetary gain, contributing to personal fulfillment and a more impactful life. So, there you have it, team. The key differences in financial habits between rich and poor Indians, laid bare for us to understand and learn from. We've journeyed through the world of appreciating assets like real estate, the importance of diversifying with stocks and bonds, and the profound lifelong value of investing in education and self-improvement. We've also looked at the pitfalls of depreciating assets and the crippling burden of high-interest debt. The patterns are clear and the lessons are powerful. It's not about where you start, but the direction you choose to move in, armed with this knowledge. The path to financial well-being isn't paved with luck. It's built with conscious choices, discipline, and a commitment to long-term thinking. It's about shifting your mindset from short-term gratification to long-term security and growth. Remember, every small, smart decision you make today contributes to a stronger financial future tomorrow. Whether it's starting a small, systematic investment plan, dedicating time to learn a new skill, or consciously avoiding unnecessary debt, these actions compound over time, creating a powerful momentum towards your goals. You have the power to rewrite your financial story. Make smart choices, my friends, and invest in your future. The principles we've discussed today are not exclusive to the already wealthy. They are accessible to anyone willing to learn and apply them. Take this information, reflect on it, and start implementing positive changes in your own financial life. Don't forget to like this video if you found it insightful, share it with someone who might benefit, and subscribe for more deep dives into topics that empower you. Until next time, stay curious, stay informed, and keep building that dream.